Hey guys, welcome back to my channel. Let's talk about opportunity costs that influence your personal financial planning. What are personal and financial opportunity costs? It simply means whenever you make a choice, you have to give up or trade off some of your other options. When you are saying yes to something, you are also saying no to something else. We have choices to make every day, and the choices we make today affect our future. So, when making your financial decisions and plans, consider both the personal and financial opportunity costs carefully. Let's talk about personal opportunity costs. Like any other financial resources, your personal resources consist of your health, knowledge, skills, and time required management. Do you eat a lot of junk food and avoid exercise? Do you get enough sleep each night? The decisions you make about your health now can have consequences as you get older. In much of the same way, the financial decisions you make today will affect your financial health in the future. For example, suppose that you and your friends have tickets to a sold-out concert this Tuesday night. On Tuesday afternoon, your algebra teacher announces an important test for Wednesday. You must now decide whether you will go to the concert, study for the test, or somehow do both. The opportunity cost of going to the concert might be getting a good grade on the test. You have to decide how to use your time to meet your needs, to achieve your goals, and to satisfy your values. Next, let's talk about financial opportunity costs. You also must make choices about how you spend your money. For example, if you have 200 extra this month, would you buy a pair of sneakers you saw at the mall or save that money? You cannot do both because most people have a limited amount of money. To help make choices, consider the time value of money, which is the increase of an amount of money due to earned interest or dividends. If you decide to save or invest the 200 instead of buying the sneaker, that money could be worth more later because you will earn interest or dividends on it. On the other hand, perhaps your sneakers are worn out. In that case, your current needs would determine that trading off interest earnings is worthwhile. Every time you spend or invest money, think about the time value of that money as an opportunity cost. For example, if you start early in life to save money for retirement, you will probably be able to live comfortably in the future. There are a few ways to help you in making wise decisions. Now let's talk about interest calculation. One of the ways is to do interest calculation. You can calculate the time value of your savings by figuring out how much interest you will earn. To do this, you just need to know the principal, the annual interest rate, and the length of time your money will be in an account. You can do this for free on a few websites. For a savings account, the principal is the original amount of money on deposit. For a loan, the principal is the amount that you borrow. When you open a savings account, the bank or financial institution identifies the interest rate for your account. This is usually given as an annual percentage so that you know how much you will earn each year. By comparing interest rates at several financial institutions, you can figure out which one will make your money grow the fastest. You can figure out how much interest your money will earn in the first year by multiplying the principal by the annual interest rate. Now, what about the future value of a single deposit? Now, this is another method, which is to calculate your future value of a single deposit. Future value is the amount your original deposit will be worth in the future based on earning a specific interest rate over a specific period of time. Figure out how much your savings will earn and grow by multiplying the principal by the annual interest rate and then adding that interest amount to the principal. You can determine the future value for 2 years, 3 years, and so on. Each year, interest is earned on your principal and on previously earned interest as well. The calculated interest earned for the second year, you just need to add interest earned in the first year to the principal. Then take that amount and multiply it by the annual interest rate. Future value computations are also called compounding. With compounding, your money increases faster over time. If you make deposits now, your money will have more time to increase as well. Now, another one is called present value of a single deposit. Another method is calculating the present value of a single deposit as mentioned before. You can also calculate the present value, which is the amount you will need to deposit now in order to have a desired amount in the future. You have also future value of a series of deposit or present value or a series of deposit. Now, and of course, there are also the future value of a series of deposit as well as the present value of a series as deposit as mentioned before. Some savers and investors like to make regular deposits into their savings. A series of equal regular deposits is sometimes called an annuity. Let me know your thoughts on this in the comment section below. Don't forget to subscribe, hit that notification bell, give the video a like, and share it with your friends and family. Thank you very much for tuning in, and I'll see you in the next one.